Hello, everybody. It is November 3rd, a day removed from Fed interest rate and Chairman Powell speech day. And we have seen quite the reaction from the markets. So what is going on? First of all, the Federal Reserve raised interest rates 75 basis points yesterday, which was pretty much expected. The statement came out about a second later, and the market started to rally on this idea that somehow the Fed was going to start backing off soon. During the question and answers and during the statement from Chairman Powell about an hour later, he made it very clear that was not the case. He was very, very hawkish. He was very mean. He did exactly what I had been telling you for weeks he was going to do. He's trying to drive the stock market down so that he has the leeway as soon as they see signs on inflation that they can start to back off. Now, we know that the leading economic indicators are already starting to show signs that we're headed for a recession. The only number that's not getting beat up is unemployment. And here's the problem. It really probably is pretty sinful to throw people out of work during an inflationary period. If we get a big recession with a lot of unemployment, that means the Federal Reserve and the federal government are just going to have to bail everybody out again anyway. Spend a lot of money on unemployment benefits and welfare benefits and extra benefits and this loan program and this other thing and that other thing. So I don't expect it to happen. I think we're still going to get that soft, shallow recession with not much in unemployment, because if the Fed causes a lot of unemployment, we have a really big problem, because that'll kill supply chains. And we know that inflation is coming from oil and supply chain, a little bit from housing, a little bit from wages, but mainly oil and supply chains. So if oil ceases to be a big problem, because maybe the Saudi Arabians help us out on that, but I'm not counting on it. I'm getting really afraid of that Iran war finally showing up. I mean, maybe if China gets rid of zero COVID policy, we can see supply chains loosen up, especially while we keep building things here. It all comes down, I think, and I've talked about this over and over again, we are trying to wait this out without breaking the economy. And in an economy where it's the supply side that's causing the inflation, we have a problem, because causing a recession really won't fix the supply side. In fact, it would hurt it. So we need to find a way of muddling through this inflation until energy costs come down and until enough of the supply chains have moved, both of which are going to take another year or two, maybe 3 at the outside. We might have to live with higher inflation for a while. We've talked about for years how the central banks and federal governments around the world were going to use inflation to devalue their debt anyway. So when they talk about inflation and unemployment, I think you should ask yourself the question, what are they really talking about? Are they talking about devaluing their debt? If they are, then we really don't need to kill inflation all that badly. And what if they're talking about currencies? All these things are tied together. What if the dollar being super strong right now, beyond the fact that we just have the cleanest dirty shirt, maybe they're manipulating the dollar upwards. Maybe they're weaponizing the dollar. We talked about that last week. I have long told you, because I made this observation in the early 1990s when I was a student, the Fed's real job is to protect the dollar, to keep it the king currency. And the Fed doesn't have to do much to do that. By raising interest rates to almost normal, not even normal, to almost normal, the dollar has soared. Ask yourself a question. How strong is the dollar if normal interest rates cause it to go through the roof? I think that's something that should help you clarify that all these people who pound their chests about the dollar collapsing eventually and imminently and definitely are still as full of shit today as they were yesterday and 5 years ago and 10 years ago, when I said that the dollar would go on a bull market, and 15 years ago and 20 years ago and 30 years ago. The dollar's never collapsed. But that narrative has been out there since the 1950s, really took hold in the 70s. And it's become basically mantra and dogma for a group of people on the internet and business people and bought and paid for mouthpieces who pretend to adhere to an Austrian economic theory that they don't understand about business cycles and currencies. The idea that a currency has to do with a balance sheet is wrong. It's always been wrong. Strength of a currency has to do with the productive capacity of an economy. And to that end, the United States, on a per capita basis, for the large economies, is far and away better than anybody else. China produces about as much as the United States, with 4 times more people. India produces what? About a third of the United States, with about 3 times more people. Europe produces less than the United States, with more people. And think about what it really means when the Fed is talking about raising interest rates even more and then keeping them on a higher plateau for a longer period of time. What does that really get at? Doesn't that support the theory, the thesis that I've been giving you for years now, that the dollar is in fact going to stay extremely strong, and that the United States is going to essentially become a gigantic Switzerland, producing way more and just generating gobs and gobs of wealth as the millennials hit their peak earning and spending years, and what's left, the second half of the emerging markets, develop. And what you're about to see in not too far away land, not a too distant galaxy, but probably 3 or 4 or 5 years from now, you're going to see one of the biggest economic booms in history. And there will be a lot of transition. There will be a great divergence between the old economy and the new, what's rebuilt and what's torn down, what's built new. And you better be invested in what's coming. You better be patient because it'll be rocky, and the narratives will get louder and then fade out and then louder again and fade out. But ultimately, in the short run, there is a big risk. And the big risk is that the Federal Reserve oversteps. Here's what I think. I think you ain't seen nothing yet. Just played the video for everybody. Bachman Turner Overdrive. Can't play it on YouTube because it hit me with a copyright infraction. Yesterday, they raised it 75 basis points. Chairman Powell was mean and hawkish. Right? I've been using the word mean for a while. And he was. He came off mean yesterday. And the market got beat up yesterday after he spoke. It started way down today, and it's been rallying back a little bit. Some sort of hopium is out there. We'll see. If the Federal Reserve wants the stock market to correct, all they have to do right now is shut up. Chairman Powell has to tell the other Fed people, say what I want you to say, otherwise shut up, because this market is fragile right now. The frightening thing is what could happen. So I'm not done with the article yet, but this dividing the Fed section, I think you should take a look at while I have it up. I've been talking about all this almost all year. I originally thought that the Fed should start to back off in September. Figured out during the Jackson Hole speech that wasn't going to happen. Jeffrey Gundlach went after them going into the last meeting in September. I agreed with them. I don't always agree with Gundlach, but I agreed with them. And at this point, I don't think anybody thinks that we're not going to get a 50 basis point or 75 basis point increase in December. But there's 2 employment reports and GDP reports coming. And ISM numbers, there's 2 batches of basically all the data before the next meeting. I think the window is very open, or at least open a crack, but I think open enough that the Fed may only raise rates 25 basis points in December. If inflation drops a little bit, they can start to claim victory and say, maybe we can't engineer this soft landing, because yesterday he said he probably can't. Maybe we can engineer this soft landing. We're only going to raise interest rates 25 points because inflation has started to abate. That's a scenario that could happen. Another scenario that could happen is that energy prices firm up again, inflation ticks up because during the fourth quarter, everybody stays employed and the employment adjustments don't really take hold till the first quarter. Although we have seen a lot of headlines. If you go on Bloomberg and you just type in the word unemployment or layoffs, type in the word layoffs at Bloomberg or even probably Google, you will see a lot of companies with hiring freezes and the first parts of layoffs. And yet the JOLTS number still came in way above a week ago, which is probably why we saw 75 basis points, in my opinion. If that JOLTS number had gone down, job openings had gone down, I think the Fed might have been a little nicer, but it was way over forecast. A lot more job openings than they expected. Layoffs haven't taken hold, and people aren't quitting as much as they were. So the economic landscape looks like this. The economy itself is starting to plateau. You're probably going to see GDP negative in the first quarter. I don't know what it'll be in the fourth quarter, but I'd say below the 2.6 that we just saw for last month. I think you start to see ISM and other manufacturing measures tick down again in December, which is normal. But I think it might be more pronounced because if I'm reading things right, and remember, I'm in a manufacturing city, and they're all telling me that their backlogs are shrinking, they might be more likely to take an extra day off or do a maintenance day or do things, lower production and output by a few percentage points. I also think you're starting to see a lot of problems in the real estate market, not only on the residential side, but on the commercial side. Yesterday, I was talking with private equity people I've been talking to, and he reminded me that virtually all commercial loans are on 5-year resets, right? They don't get 20 and 30-year loans. They get 25-year amortization, but every 5 years you have to redo the loan. So the loans taken 5 years ago at super low interest rates, and all their math based on those loans, when they had to redo them this year, the cost of supporting those loans went way up. So in a report from, I believe it was CRB, I'll have to pull it up, negative equity, and you can Google this too, negative equity in commercial loans has skyrocketed to the point where the conversation I had yesterday took kind of a surprising turn. At least he said something that stood out to me, didn't really explore it more. But this is a company that's built some buildings, good buildings. I mean, neat buildings and, some of the mall areas that are starting to go multi-use, mixed use, some other buildings out where you weren't going to expect brand new. And then all of a sudden you got a lot of brand new, but kind of your class B office space, retail, residential. And he said something that I'm going to ask him about next time we talk. He mentioned that some of the class A office buildings are really running into some problems right now because they're only at 50, 60, 70% occupancy in a lot of places. And now they have more expensive debt. So all these people who are jumping on REITs right now, they ain't seen nothing yet. Because if these interest rates stay on a higher plateau, as Chairman Powell discussed, you are going to see a significant reset in real estate. It's only some of the industrial and storage and specialty that'll escape it. But residential buildings, all sorts of commercial and office buildings, they are in for a world of hurt, especially at the commercial and office, if they're not at 100% capacity or close to it, 100% occupancy, I should say. So buildings that aren't at 100% occupancy with higher expenses than there were in the past are going to have a problem. Not so much on the residential side, but some on the residential side. Although it looks like they're not going to be able to pass on the rent increases. One of the other things in the conversation is that it looks like rents have pretty much peaked. And they too might be on a plateau for a while because, they never really go down. They might offer some specials. I just sent something to Open Door. I said, hey, stop being stubborn. Rent out some of these houses for a year. Reevaluate then. Why sell at a loss when you can get 12 months of rents that guarantee that you'll sell at a profit? So what we are seeing is the Fed about to make a decision in December about whether or not they cause a credit crisis. Tree Rings put out something that basically echoes all the things I've been saying again. Put it out this morning. Treasury Secretary Yellen is worried about loss of adequate liquidity in the U.S. Treasury market. The Fed is running into a point here where they really can't get too much tighter. But as we talked about months and months ago and showed some of their statements, they really want to see the stock market correct on the valuation side. So that's what we have to wonder is how far down does the stock market go? Start of the year, I said that we'd hit the low 5,000s and then get back to the middle 3,000s. We almost got to the low 5,000s. We were at 48.18, and we are, by all measures at this point, all indications at this point, I think headed to the middle 3,000s for sure. This is the chart from early in the year. I said the low end would be about 300 on SPY, but it may barely get under 400. Well, we're going through that support area right now, and it looks like we're headed into the middle of this. The top of the 2020 market is another support zone. And then right before the 2019 QE, another support zone. So how does that look on a chart? So I've lowered the base case by about 20 points on SPY and coincide with, will we hold the 2020 top? Or are we going to get back down to this level, which is a level of support, right before quantitative easing in September of 2020, the quantitative easing in 2019 that was done to support the repo market. Remember, what is sitting there right now? What does the Fed have access to right now? They have $1 trillion sitting there earmarked to support the repo market. There you go. It'll pass through. So the Fed, out of one side of their mouth, has the ability to say that we're doing quantitative tightening. And then on the other side of their mouth say, hey, do you need some money? It'll be interesting to watch. I have a hard time believing we go below basically that double top right there. Upper 200s, that 2019 repo QE level. Have a hard time believing it will go below that. Doesn't mean we won't. If the Fed stays too tight too long, and especially doesn't slow down soon, and have a good way of saying why they did it, we could see these other levels. Here, this green trend line is the end of the 2014 to 16 sideways stealth bear market. Chopped along, started to break out, retested, and then took off. So from that point right there through the bottom of 2020 should be pretty massive support. Should be. And I think all the Fed would have to do, I don't think they'd have to bail anything out. I just think they'd have to back off. I think they'd have to end quantitative tightening, lower interest rates a quarter point. I think both things could happen next year. We'll see how healthy the economy stays when we will see what the international shocks are. We don't know those things. There's no magical trading system that can tell you what's coming. Sentiment may speak, but liquidity is truly the one holding the puppeteer strings. So I think what really is the truth, and I've always thought this is why I follow money flows. All of you who have been with me a while know I follow money flows. I think that liquidity speaks and sentiment listens. I think that's why the stock market had those wild swings yesterday. I think that's why it's acting confused today. You still have a lot of people who don't realize what the world is like. They don't understand what happened in 2008 because either they didn't understand it then or they were too young. Sam Zell today and prior, Nouriel Roubini, Jeremy Grantham have all talked about this happening based on a liquidity crisis. So you've got Janet Yellen talking about it while the Fed is trying to talk inflation and the stock market down. Because as the stock market gets lower, they can say, hey, we've seen enough signs, we're going to stop this. But when the stock market's way up here, this is clearly, this hump here shouldn't exist. Stock market should be down in here somewhere. And this range is where the stock market should be based on valuations, based on the notion that QE is not normal, even though it kind of is. So you really have to pick your spots. You really have to move slow. You really have to evaluate your risk levels. Because I'll tell you what, if Saudi Arabia and Iran go to war, or if Israel and Iran go to war, which just became a lot more likely. Why? Netanyahu's back in charge. At least it looks that way. I don't think it's official just yet, but he has all the votes lined up. U.S. State Department said they're not going to bother even negotiating with Iran anymore because they've taken just such an imbecilic stance. And they don't want to give the government of Iran a win right now with the women of Iran rising up against the theocracy. There is a lot going on in Iran right now. And you can hypothesize that if Iran is going to become more aggressive with the world and with its own population because they feel threatened, it can't make Saudi Arabia feel very well. Can't make Israel feel really good either. Seeing as Iran has basically said they want to wipe out Israel. And we know they're close to having a nuclear weapon. They for sure can make a dirty bomb. So what are the likelihoods? In 2017, I talked about this extensively. And I said, sometime in the next 5 years, it's going to happen. We are right at the 5-year mark. Could have just as well said 7 or 3. It wouldn't have mattered. The pressures that have been building up in the Middle East between the pressures that have been building up in the Middle East between Saudi Arabia and Iran and Israel have been a long time in coming. And now the Ayatollah wants to make his son the next Ayatollah, and his son is even more of a dipshit than he is. And the women of Iran, what have I said over and over and over again about the Middle East? Is that the Middle East changes when the women of the Middle East make a change, and they're doing it right now. But if something comes to pass there, you're going to get a shock. It might cause energy to be even more expensive for a while. Russia. We've talked about what could happen if Putin looks like he's going to lose power. He could get more desperate and do something worse, or he could get overthrown or killed, but it's the right wing that takes over and not the moderates. And then they do something bad because they're ultra nationalists. What if China, and I think this is the least likely scenario at this point, what if China starts bombing Taiwan? I don't think they will. I think the news in the last couple of weeks was positive with regard to how Biden and Xi are talking. And Biden is basically saying, look, you can keep the one China policy. Just don't invade them. Just keep negotiating with them. Just keep trying to build your economic ties. We don't care. Just don't bomb them because then we have to fight with you. And Biden put a lot of pressure on China, took away a lot of technology, and more importantly, he took away the people. All those people that quit their jobs in China, American citizens working in tech who are threatened with losing their American citizenship. I told you that Biden's a badass. I know people don't want to think it, but he's that old guy that talks about fights that he had, and he's not lying, that he whooped a lot of ass. And while he's out there for the polling, right, for the voting, for the election next week, yelling at the oil companies. The reality is he's got to deal with them. He did exactly what I said he was going to do without the contract. He told them, keep producing oil, because if the price goes down, I'll buy it for the SPR and put a floor under it. So over time, everything's going to get better. But we don't know how bad this chart is going to look at the end, because some of these bad international things happen, or if the Fed screws up, this can round trip all the way down to making a run at 2,000 on the S&P 500, because this pattern here is a megaphone pattern. Northman Trader has talked about this, so have several other big technical analysts. They've identified different megaphone patterns. They were looking at the bottoms in 2018. I don't think that's a broad enough time frame. I think it always has to be longer than 2 years, and you don't have to go bottom to bottom. But what you can look for are these periods that ended up being breakout periods to a prior upcycle, see where it goes through a down cycle, and then see where it hits again. Look at this line. In fact, I probably ought to put it here because that's where the breakout is. And look, it gets down there, then it widens out. So this is your floor right there under most technical scenarios. You know, somebody actually drops a nuclear weapon, who knows how low it can go. But this seems to be as bad as it can get, making a run at 2,000 on SPY. Again, I don't think that's very likely. I think a lot of bad things would have to happen, or the Fed would really have to screw up and not care and take their time. Maybe screw up twice, maybe screw up and then move too slow. From here to here is very possible. And people who are complaining about this to here don't quite understand that this should have never have happened. That was just a rally, hopium and cheap money. Now money's almost normal priced, not quite, probably won't even get to normal. But think about how the interest rate cycle works. From the early 1980s to a year ago, interest rates went down, essentially. We had a 40-year bull market in bonds. And the bond guys out there are telling people to buy bonds. I think they're early. I think the time to buy bonds is probably a month or two out, maybe 3 or 4 or 5. Just like I think the time to get fully invested in stocks was a month out, but maybe 2, 3, 4, or 5. And I'm putting that extension on because we don't know what December holds. But here's my thesis. I think the Fed is going to back off just a tiny, tiny bit in December. I don't think they'll screw up. If something bad happens internationally, this will be an excuse for them to do it. If inflation ticks down a point, that'll be a reason for them to do it. If ISM is too low, that's an excuse for them to back off. If unemployment goes up by 0.5 point, that's an excuse for them to back off. Historically, that's always been a recession. So what should we be looking at in the next 5 weeks, 6 weeks between now and the next meeting before the Fed? Inflation numbers, employment numbers as a harbinger, ISM, what's going on internationally. And so for those of you who want a magic show, that's it. That's all there is. All you can do is identify the scenarios. I think this box is still the most likely. I've lowered it a little bit to coincide with these two levels and where the pockets are on demand. So I talk about money flows from time to time. It's not hard to see the market drop from here to here because there's not going to be a lot of buyers. If the market does follow through on dropping, it's going to run into a spot where there's just not a lot of buyers. Then it gets to about here, which absolutely is accidentally hitting a fib line. Down here, it's basically hitting a fib line too. So you have multiple things on the chart here lining up. Fibonacci's, quant factors, money flows, then always the possibility that the Fed says something nice. So this range is what you're looking for, in my opinion. Something bad happens internationally, probably go lower, not much. And if the Fed screws up in December, I think that's really what opens up all this stuff down here. At a minimum, I think the Fed has to be very dovish in their speech in December, even if they do a 0.5 point. If they can do a 1/4 point and basically declare victory, then we'll be in good shape. Remember in 2020, I told you to watch the employment numbers. When all those people got laid off, they got bailed out fast enough that they didn't have to sell their 401ks. In 2008, people were selling their 401ks, lose their job, sold their 401k, tried to stay in their house. A lot of them lost the house anyway. And that's why that bear market was very rugged for 9 months. This bear market is going on, 7, 8 months right now. It's been pretty rough, but it hasn't been horrific. If the stock market gets down in here, that would represent about a 60% correction off the top. That's a doozy. A 30%-ish correction is run of the mill. So all the people are bitching and moaning and whining and crying about the stock market's down 20, 30, 40%. Realize that's normal. And it wouldn't be so bad given the stupidity of this run up. From about here to here is what is abnormal. Look at the slope. Not supposed to have done that. Somebody asks, why isn't VIX spiking? Because there's still enough money in the system and enough traders who believe in their God-given right to make money on every single day that they haven't panicked yet. At some point, you would expect capitulation, panic, high volatility, and a thud on super high volume. But it hasn't happened yet. And maybe this time is different than every other time, right? Maybe it's different this time. Those words have been called the most dangerous words in investing. Maybe it's different this time. Yes, a thud. A super high volume, big down day or week where everybody says, oh shit, this is real. I'm just giving up. A Haynes bottom moment. Look up the Haynes bottom. March 8th or 9th, 2009. Mark Haynes on CNBC, this giant whoosh down in the market. A lot like, I think it was March 23rd or 26th for COVID. Super high volume down day, funds dumping, retail dumping, everybody's orders going through at once. You exhaust the selling on those events. And that's when you start to see rebound rallies that everybody doubts become new bull markets as people slowly believe month over month over month. And unless there's QE, it'll look different than this. It'll look more like this. Still up, right? But it took longer, right? I'm not going to go through any more charts today. I want you to marinate. And I don't really know that you need to be obsessed with volatility. It's not a trade that you should be trying to make in most cases because it's an incredibly hard trade. I have made that trade several times in my career. The best trade I ever made was in 2018. I told everybody 6 or 8 weeks before the volatility event was going to happen that it was going to happen. I gave everybody a 2-month time frame that it would happen in, and that's what did. That's where some of those quotes come from in my ratings. I'm just telling you, the volatility signals that I am familiar with, I'm not seeing right now. It's not coiling. There's not a lot of people selling vol. You just have a wishy-washy market. It's undecided. The Fed is trying to get it to decide. The Fed wants to see the stock market get down to those 2019 and 2020 levels. That's where I think the Fed makes a stand. But they want to see these valuations reset. Now, I don't know if they want something more, right? I don't know because they don't call me. I ask them to call me. They don't call me. They don't want to go out with me. I say, hey, Chairman Powell, you want to go grab a beer? He says, who are you? I don't think they want to see it come down here. The reason they might is because that would be a great valuation reset, and people would draw the line from this bottom to this bottom and say it's the new bull market. So maybe they do want to see it go down in here. I don't know. Neither do you, and neither does anybody else. But the thing that you have to worry about is, does liquidity get screwed up internationally or because of the Fed? Think about what happens if some of the REITs just start going under, or having to issue tons of new shares, or pay much higher interest rates and they can't make their dividend payments. Think about what happens if capital-intensive companies, which we've talked about over and over again, can't get financing. That'll screw up supply chains. I guess the one thing I would tell you to keep an eye on is copper prices. If copper drops any more, we might be looking at a great opportunity in a couple of places. Goldman Sachs basically said copper is going to quadruple from this point this decade, yesterday. We'll see if they're right. If they are, we know what we want to do about it. All right. This does not look complete. If you just look at the picture, it doesn't look complete, does it? In here could be complete. Down here, it's even more likely to be complete. And down here, unless it's truly the end of the world, certainly it is. I don't think we're going to get the Armageddon zombie apocalypse, but it's not out of the question. It's more likely than normal. And you have to think about how much risk you're really willing to take, which is why when you slice up your portfolio and you decide how much you're going to hold in cash short term, because that's your best hedge. And remember, cash has not been trashed this year. It's up. You have to decide when to invest. So I like slowly scaling in, and you scale in faster the lower it goes from here. Because down in here, this is the question to ask. Where does the Fed act? In my perfect world, we actually get to close to the green line, and we start a monster long-term bull market. And it's very possible that could happen because the millennials, again, are entering their peak earning and spending years right now. So I'll leave you with this. Remember the other thing we've talked about: invest like a millennial. They're inheriting the money, they're earning the money, and they're spending the money. They're going to be the ones that push certain stock prices up and real estate prices up, and other stock prices down and real estate prices down. I'm going to be writing an article about REITs and real estate investing in the next week or so by Thanksgiving. And I'm going to outline some things that have just been amazing to me as I've gotten more and more involved in commercial real estate and real estate development. Those of you jonesing to get into the REITs, seeing some of these articles, I want you to remember the authors on Seeking Alpha and everywhere else who've been telling you to pile into REITs this year. Clock hasn't come around on that yet, has it? They're losing a lot of people a lot of money. Meanwhile, I told you 40, 50, 60% cash at the start of the year. So I guess I'll ask you for one favor. Tweet some of my stuff out or put it on your Facebook page, especially, or Instagram. I don't care where you put it. Get it out there. Because if more people had held cash at the start of this year, then slowly scaled in, they'd been way ahead. And if those people start buying 4IR and decarbonization, fourth industrial revolution and decarbonization, and part of the blockchain world, which is technically 4IR, they can make all their money back. So anything you can do to help out, get the word out, that we've been doing it right. Comments in the articles. Thank you for those of you who have come to my aid from the trolls. Comments on the YouTube page, whatever. I would encourage you to start talking to people that you know, because if this happens, a lot of people are going to sell down here. And really what they should do down here is shift into this to make their money back. We need to think about the next bull market. How do we navigate the last couple innings of this bear market and then the next bull market? Speaking of the last couple innings, did you watch that baseball game last night, that World Series game? Second no-hitter in World Series history. 4 pitchers. Looking forward to Game 5 of the World Series. This is shaping up to be one of the better World Series in a long time. So if you're a baseball fan and you just haven't got to it, man, you should go watch these games because they are pretty exciting. All right. Take care, everybody, and keep an eye out for more articles. And I think we've got quite a few that have come out lately. But we have to monitor this because we don't know what's around the corner. We're trying to stick our head around the corner first, but it's not real clear right now. All we know is that the Fed wants the stock market lower. So that is the path of least resistance in the short run. All right. Take care.